Hello, accounting has to do with the accumulation of data into relevant information. The accounting data that we're going to enter is usually the day-to-day transactions. Those transactions are going to be things like the bills, things like the invoices, things like paying wages and whatnot. Those are going to be the day-to-day transactions. We're going to compile those in something. You can think of it as basically a database, a computer. We're going to format it in a particular way. We're generally going to use debits and credits in financial accounting. We'll talk about later. This is a trial balance here. And the end result is often in the format of financial statements. The end result is to have something that is going to be useful to either or both internal users and external users. And we'll talk more about who internal and external users are, but we want to find the data and put it in a relevant format in order for people to make decisions with it. Usually that's in the format of financial statements. So why learn accounting? I'm going to say because it's fun. And that might not be the first thing that popped into your mind, but accounting is something that we figure things out, we put things together similar to like a puzzle, and you get a similar satisfaction from that. You can also compare it to like a checkerboard, where checkerboard's on a nice spreadsheet here. We have a nice spreadsheet and we move the pieces in accordance with a set of rules. Accounting is very similar in that we work it on a nice spreadsheet and we move numbers around in accordance with a set of rules. And again, you can get a similar type of satisfaction from that. Obviously, the other reason to learn accounting is that it's going to be useful information in terms of the performance of a company. So it's going to help us to see how a company is doing over time, and it's a measure of how a company is doing over time. It's also a measure of how a company is doing at a particular point in time. So if we want to look at performance, financial statements are one way that we can measure performance. So there's going to be two types of accounting that we're going to talk about. There's going to be financial accounting, there's going to be managerial accounting. Most accounting programs start off with financial accounting, then move over to managerial accounting. The financial accounting is that accumulation of data. That's going to be the day-to-day transactions, recording wages, recording sales, recording the other expenses, and then compiling it, making financial statements. The financial accounting is geared towards external users, meaning creditors, government, investors. So that means it's going to be more regulated and you have to have it more precise. As opposed to managerial accounting, which is going to use the same information, a lot of the same information, but they might use more information and they might put it in a different format in order to meet the goals of whatever management wants. Management may want to drill down on certain things and look at certain things in a different way. There's not that same type of regulation for management. They can do what they need to do and use the accounting resources to make decisions. So we're going to have three types of businesses. We're going to have a sole proprietor. That's going to be one owner. We're going to start off with a business that does not have inventory, a service company, and then we're going to record all the transactions, and all those transactions we're going to record, such as recording expenses, recording sales, recording wages expense and whatnot, are going to be the same for other types of companies, such as a partnership. So when we move on to something like a partnership, we're not going to go back over all those too much. What we're going to do is move on to the things that are different. What is different? Well, there's two or more partners in a partnership. So that means the equity section is different. We got to split the income out. And so when we move to the partnership, we'll concentrate on the equity section and the two owners. When we move to the corporation, again, a lot of the stuff's the same. We're still recording sales, still recording wages, still recording the utility bill. All those are the same. What's different? Well, the equity section, once again, is not partners now. It's going to be stockholders. And so we're going to have to see the reformat of the equity section and see how we deal with it in terms of stockholders. Also, we have a separate legal entity that we will talk about as well.